have one last session, which is our bonus fireside chat session between me and my former partner, Eric Sibbitt. So we're going to sit up here and talk. So this is really kind of a lawyer to lawyer talk, even though I don't practice law anymore. What we noticed was that a lot of startups out there and a lot of others, I mean, investors do have a need to stay current with respect to how legal structures are being changed and recommended by the community. I mean, the speed of change in crypto is blinding, as we all know. And accordingly, the structures that are needed, of course, probably should change from time to time as well. And so I certainly haven't been following as closely as Eric. Eric is a specialist in fintech and crypto practice at Hastings, where he heads that practice. He used to be with O'Melvin in my former firm as well. And so we thought we'd just sit down and go through some of the key structural elements of crypto projects, crypto entities, and see how that has been changing over time and recently. So I'm going to start by asking, well, do you want to say anything else about your background, Eric, before we go on to the questions?
No, I mean, I realize that you've got a lawyer standing behind what you really want to do. So maybe familiar.
Okay, so I'm going to pretend like I don't really know anything about this and just ask you a lot of questions because I actually don't really know much about this subject anymore. But so maybe we can start by trying to lay out a taxonomy of what are the different structures and elements of a legal structure for a crypto project or a crypto startup. I mean, we have so many different dimensions and variables in these projects. You know, it could be decentralized, it could be centralized, it could be US based, it could be overseas based, it could be issuing a token, it could be not issuing a token, it could be focused on a particular line of business that is more conducive to a central business plan or not. I mean, tell us what the different big buckets of structures there are and what affects it, Eric, just from the top.
Yeah, I mean, so a great question, a question to get a lot. So, you know, in the old traditional world of startups, it was very simple, right? You're going to raise money, you're going to form a Delaware C Corp, and maybe in some situations you form an LLC, right? What is really interesting about this space is there are so many different structures and approaches, and it really, there's not a one approach to all of this, right? And so there's a lot of balancing between these different components, whether it's regulatory, tax considerations, what's really the ethos of the community, how you want things to function, reputational considerations, et cetera. And so, you know, a common theme for a lot of projects is, you know, so we're talking about DAOs, right? And there are a lot of different kinds of DAOs from a legal perspective, right? Sort of the simple picture of a DAO is kind of analogous to, you know, people used to come together, pool some funds, build a park, build a church, build a school, et cetera, and kind of make that for the community, right? The crypto, you know, analog to that is people coming together, maybe they form a multi-sig wallet, right? And pull those funds and then go out and purchase maybe real world assets. Maybe they issue a new token, do other things. But what is, you know, kind of become very complicated is that when you kind of work in that kind of pure world, the legal liabilities, the tax exposure, a lot of those things start to unfold. Or so you've got the DAO from one example, right? Or you have a traditional early stage crypto company that wants to raise money, right? But the vision is to ultimately be decentralized. And so how do you go about approaching that? And so there's a lot of complicated questions in terms of, you know, do you do this onshore? Do you go offshore? Do you migrate? And often the story is you start off in one place and you move to someplace else, right? And so, you know, now when we look at this, you know, it's complicated. You know, are you going to form a non-stock Delaware foundation? Are you going to form a Cayman entity? You know, are you going to do a Wyoming DAO? There's a whole alphabet soup of different types of structures that people are trying to map onto what they really want to achieve. And a lot of the time, people are picking the wrong approaches for the wrong reasons, right? So a lot common driver is regulatory, right? So people say, okay, regulation in the United States is crazy. There's uncertainty. So I want to create an entity overseas. Sometimes that's the right answer. But often if you are in the United States, providing services to people in the United States, your servers in the United States, that doesn't necessarily insulate you from all these things.
So that's an overview of all the different possibilities. Now let's just dig one layer, pull back the onion one layer. So first of all, what are the most common structures that you are actually seeing now that are most appropriate? I mean, I know it depends on the different variables, but what would be the few archetypical structures that you are seeing most commonly in the practice?
So, I mean, probably the most typical structure I see for a US-based project, right, is first it starts off very simple. Delaware C Corp goes out, raises some money. Maybe it's a safe and a token warrant, maybe it's SAFs, builds, and then prior to launching will form an offshore entity, most typically a Cayman entity, Cayman Foundation, if this is meant to be governed by the community. And then because of some of the restrictions apply there, they'll form a BVI subsidiary. So that is like the most, past 12 to 18 months, by far the most common structure.
Okay, so then let's weave into that, the financing structure. So what things are being issued? Is it equity? Is it tokens? And who's issuing what?
So, I mean, probably in the earliest stages, what's most common now, it's almost become a bit of a playbook, is doing a safe, like a traditional Y Combinator-like safe with a warrant, or sometimes called a token purchase right. And part of the reasons behind that, one, from the investor perspective, you have one foot in the equity if there's value in the equity, and then you've also got a foot in the digital asset. Also, from the founder's perspective, that's often more attractive from a tax perspective, because your safe is not taxed, whereas the sale of digital assets generally is going to be, just a question of when and how. And so you often see these structures where someone's putting in, say, $1 million into a safe, and then there's a warrant associated with that as a kind of a kicker, or maybe it's got a separate allocation for that purpose. And so that's to help maximize some of the tax considerations. And then how the warrants are built can vary a lot as well.
Okay, and then let's talk about the breakdown of the different pieces of the token pool that typically would be issued. So some being issued to management or to employees, other to investors, other to customers or users, others to the foundation. So how does that typically, what are you seeing there?
So, I mean, there's, as you might imagine, I mean, there's quite a range. I think probably what is a common ballpark is, kind of call it for a founding team, you're seeing like 10 to 20%. Maybe for early investors, it's roughly 50% of the overall ultimate supply, with 50% going to community. But there's quite a range, right? There's not one answer, and it depends on sometimes how popular a project is, what the ultimate vision is for it. One of the sensitive things is that, especially when the vision is to really operate in a decentralized way, is that you don't have too much concentration of ownership in any one person or entity.
Right, but as I understand it, there is a tension there, obviously, because you want to have the projects headed in the right direction. You want to have it, have the right policies, the right decisions before it becomes too decentralized, right? If you are decentralized completely from the beginning, then nobody can make a decision. So how do you balance those?
Well, I mean, there's definite tension right there, right? Because most of the time, to get some of the regulatory and tax and other benefits of being decentralized, in some cases, you have to give up control, right? And that's a really hard thing to do. And the reality is also, particularly in the early stages, generally people you need a core team, sponsors, people who are behind it or make sure this thing happens and happens in the right way. So it's really kind of an evolution. I mean, you do see some things where people will put in mechanisms to willingly tie their hands a little bit. So let's say you do have a large slice of the economics, right? But you don't want to be in a position of being deemed a control person, where you're either delegating your ability to vote or kind of restricting how you can vote in some way or for some period of time. So there's a variety of mechanisms there, and it usually is an evolution. It's not, most things I don't see, they're just instantly decentralized and community driven.
So apart from the mission purposes of the project, of course, everybody, I mean, people in general are trying to make some money too, right? So whether it's the team or it's the investors. So where would you be looking for the upside if you're either an investor or a team member these days? I mean, how much of it is really in the equity? How much of it is in the tokens? And, I know there's a relationship between those two, but I mean, how are people structuring these things in this market?
So, I mean, that's another one of those answers. It depends. So most of the time people believe in the digital asset, right? And increasing the value of the digital asset associated with a particular ecosystem. Sometimes it's both. Sometimes even when you're building a decentralized protocol, you are building and the equity investors are participating in an important hub, or at least participant in that ecosystem, which is going to generate its own kind of returns and cash flow, et cetera. So the answer can be both those things. And it can also be, it's not all for profit as well. So especially when we're talking about NFTs now, right? There are other things out there where people are actually setting up nonprofit entities or foundations. So for example, take the example of an NFT, right? And so there are projects working on what are the equivalent of virtual museums, right? So let's say you have a DAO, it pulls together funds, it buys together iconic works of art, right? And then we'll actually kind of build a community around that in a 501c3 type structure where at least part of this ecosystem is really truly nonprofit, even though there may be other attributes or assets or things that are associated with it that are for profit. So we see a lot of these hybrid type of situations as well.
Right. So we just talked about the potential upside, and then let's talk about controlling the downside. So as I understand it, one of the issues that especially the lawyers worry about is how to limit the potential liability of the various members of the ecosystem so that, there's not a see-through liability so that they have to pay for things like taxes or other, whether it's contract liabilities or fraud liabilities or securities law liabilities or what. So how do you think about those issues?
So, I mean, and this is something we're working on a lot of projects so the DAOs launched, become very successful, very valuable, but there's no real legal entity involved in the chain, right? And so from a US legal perspective, often what that means is you may be an unincorporated association or a general partnership, right? Where in theory, at least, you have unlimited liability for all of your partners, right? Similarly, from a tax perspective, as a partnership, you have pass-through taxation, and you may actually, be taxed without actually even receiving a distribution. And then from a legal liability perspective, people are concerned because, a lot of things in the digital assets are not clear, right? And whether you're taking on securities, other risk, there's a lot of, concerns there. So this is where a lot of people either on the front end now or some of the other projects are kind of bolting these things on after the fact, trying to build in, figure out what the right structures are, whether, people should create an LLC, which is basically, functioning like a fund, whether they're going to create a foundation offshore, a non-stock entity that's, governed by a board that's appointed at the kind of will of the token pursuant to a governance protocol, et cetera.
Last question before I let others ask questions. So, a lot of startups I run into have this high level of confidence that, oh yeah, we're decentralized. So, we're not really going to have a security here. SEC is not going to be worried about us. They've gone through this path of, starting somewhat centralized to fairly more decentralized. But how confident should they really be about them not having SEC problems in the future?
So how confident? So
depends, I know.
Yeah. So I mean, so there is an argument, obviously, kind of built on the concept of decentralization, and many are, if not all, are familiar with the Howey test, right? Where even though the reality is there is often an expectation of profit, right? That's part of the excitement behind a lot of these projects. The question is whether it's really in the efforts of others, right? And really what that means is whether there's kind of a core sponsor or project or people that continue to drive value in that expectation of profits. And so, the SEC has recognized the concept at some level, right? Something can be really community driven, like a commodity, gold or whatever, right? It goes up and down value, not because someone's behind it, but because of general market forces, et cetera. The reality of it is often more complex because it is an evolution, right? And it rarely starts off that way. And even if you kind of look under the hood, a lot of time, there are kind of important people that continue to drive things. So I think it does, when you kind of really achieve that vision, and there are a lot of people that argue about what the metrics of that should be, right? There's an argument there that it exists that wouldn't otherwise exist for, if this wasn't a centralized context. But so I think it's valuable, and it's obviously part of the the vision, but it's not perfectly, it doesn't insulate you perfectly.
Nothing's guaranteed.
Nothing guaranteed.
All right, questions? Yes, Darshan. Can you, microphone, please.
Leading on from what Howard just asked, like there is, like what degree of decentralized, there are not just securities laws that people circumvent when they do something decentralized, which, for example, you could set up a hedge fund that does something and you need to go and get regulated and licensed and all that stuff. But then if you set up a DeFi pool that does the same thing, it's like, you don't seem to need to do that anymore. And I guess what's decentralized? Like, is it 8 people running these nodes, or is it anyone running these nodes? And like, I guess, where's the line for, and if those 8 people are in like 8 different countries, does it matter? You know, do you know what I mean? Like, I'm not sure I'm articulating the question.
Yeah. And I mean, there's not, I mean, everyone's looking for this, right? There's a playbook of if I have X number or Y number, right, then it sort of means I'm decentralized, right? I think people do look at different metrics, and certainly, you know, trading platforms, for example, and others that are kind of assessing different digital assets will look at sort of, you know, what's the use, like how much participation there, what does governance look like, who actually votes, right? And what is the concentration of voting? You know, I think one metric, and this is a securities law driven metric, right, that people often use as a barometer is, you know, anyone that owns 10%, right, is presumed to be an affiliate in general for securities law purposes. So that's one thing that people look, and often a lot of venture investors, even when their economics are larger in a particular investment, will make sure that they stay below that 10% number, either through some sort of restriction on voting or other things, precisely because, and this is the risk, including the risk from a other, you know, AML and other perspective. If something truly is decentralized, right, what a lot of larger investors are worried about and founders is if the government is looking for someone to go after, then they're going to look at the biggest fish in the pond, right? And so people are very sensitive about some of those issues as well. And when you kind of go in that path, you know, obviously people are concerned about securities laws, but when you talk about sanctions violations and OFAC and everything, that suddenly gets a lot more serious.
Other questions? Come on, free legal advice, come on. Yeah, it's.
So say you're an employee of a crypto NFT company, and you need options or warrants. What sort of advice would you give on a mix of, you know, tokens which haven't been offered yet? Or are you seeing those as part of employment agreements, or is that just upside, or what should people be thinking about in terms of total compensation?
Yeah, I mean, so most of the time for you know, projects in this space, that's where people are excited about, right? They're not as excited about like the equity, right? Sometimes the equity is used to determine how many tokens you will receive. So it's a very common structure where, okay, 50% is going to be reserved for the team and existing investors, and we're going to allocate that, you know, based on the cap table prior to a mainnet launch. But on the front end, you know, if this is early in the curve, what most people want, and this is tax driven, right, is to have the actual asset, right, the actual token. So because from a US perspective, yeah, you can value it at 0, and if you actually deliver it, you actually mint it at that point in time, people file an 83B election, and then they're not taxed as things vest, right? And there are a lot of projects where unfortunately people have the wrong incentive pieces set up, and so you're taxed as you vest into a digital asset without the liquidity to actually pay your taxes, right? And you're in the worst of all worlds, right? And so depending on where you are, there are a lot of creative things that people will do. I mean, there's token unit plans, and you can set up subsidiary LLCs that allocate profits, interest, and very complicated things. But that's one of the most important issues on the front end when you're building the business, because you make the wrong steps there and it can be really punitive from a tax perspective.
Okay, one last question, maybe? Yes.
Yeah, I have like a million questions, but I'll just ask one. Where are you seeing most of the liquidity is coming from at launch for DAOs?
Most of the liquidity?
Yeah.
Well, so it depends on how the the DAO is set up, because there are some DAOs, right, where it's really limited, right? They're limiting it to like 100 people, right? And there's not necessarily a lot of liquidity in the DAO itself, right? But it may create another token, right, which it issues, right, using whatever it's kind of allocated. It's a tricky question because a lot of the time when you're launching, in theory, most people are supposed to be locked up, right? Who are people invested. And so there's a lot of, and there's some uncertainty here in terms of approach, but in terms of, use of market makers and others to try to seed that, or through an initial allocation to the community. But it's a complicated question, and often that liquidity doesn't exist right off the bat.
Yeah, I think there's a few other questions that would fall on that, but yeah, thank you for sharing.
Cool.
Okay, I think we're almost there, huh? Thank you very much, Eric.
Cool.
That was
Thank you.
great. Good to talk to you.
All right, nice to talk. And
Yeah.
I don't want to stand in people's way.
No. I'm sure they'll be asking more questions during the informal session.